Sean Duncan with SMD Consulting and Accounting. So have you ever heard of the Backdoor Roth? If you haven't, let's talk about it. First, disclaimers. Alrighty, the Backdoor Roth. Now let's take a little step back and just lay the landscape a bit. IRA contributions. There's basically traditional and Roth. There's a lot of other sub-variations, but let's just focus on those distinctions. If you make a contribution to a traditional IRA, normally it's a tax deduction. Granted, at certain higher income levels, they even take that away. But generally, you're getting a tax deduction. And in exchange for the enjoyment of a tax deduction, it'll grow tax-free, but when it comes out later, it's taxable income. Got it. Tax deduction now, taxable later. The Roth says you can forego the tax deduction, but it'll grow and come out tax-free. Well, that's kind of cool. I mean, as a trade-off, you're making a tactical decision at this moment. Do I want a deduction today at my current bracket versus paying it later? But sometimes, and most of the time, would you like to pay taxes on something now, say $5,000 contribution, have it grow over 30 years and then not pay tax when it comes out? Usually that's the case. That's why Roths are so cool, is because it's tax-free income on retirement. That's a big deal. Now, most of you are looking at me going, Sean, we're physicians. We make too much money. We don't qualify for a Roth. Well, there is a gimmick. So the gimmick is this, and it's completely legit. And it's essentially taking the rules and using the IRS rules against them, which everybody loves, right? The rules are there. It starts with, you can convert any traditional account into a Roth account. You just have to pay the tax. So let's just say it's the first year of your practice. You were making a ton of money as a plastic surgeon working for somebody else, and now it's your first year of your practice, and you have a ton of expenses. You're setting up your practice, you're hiring people. You may even show a loss on that year. Well, if you have a negative income, this is when you do Roth conversions. You say, you know what, I have this $100,000 over here that's sitting in an IRA account. I want to convert it to a Roth right now because my bracket is low. You pay the tax on the conversion at whatever your tax rate is at that moment. You don't want to do it at your 37% rate when you're really earning it. You want to do it at the low number. So this is why this rule exists. There's actually some really cool strategies we do in those years where you artificially have a low number. Yes, I'm causing tax, but what I'm doing is I'm pivoting a bunch of money into an account that will then grow tax-free and then eventually come out tax-free. Kind of a trick, right? Neat. That's actually not even the backdoor Roth. That's just understanding the rule that already exists on conversions. So here's the backdoor Roth trick. If you contribute to an IRA account this year, traditional, in theory, you get your deduction. What if you convert exactly that same amount in the same year? Well, then I'd pay tax on it, right? So if I contribute $5,000 and I convert $5,000, my deduction's kind of canceled, isn't it? Yeah. Bingo. That's it. That's the backdoor Roth. You, regardless of your income level, because there is no income limit associated with the conversion, can contribute to an IRA and then convert it immediately to a Roth, and you get to enjoy the benefits of the Roth account even though your income is too high to directly contribute to a Roth. That's a backdoor Roth contribution. Why in the world would you do it? Tax-free growth and tax-free distributions. And especially cool if you're already at a high enough income level that the deduction wouldn't have counted anyway. So let's just go ahead and play the game and get our wins. I typically do this every year in January. Now, I'm pointing out January. Way too many people try to do the conversion at the end of the year. Here's where you run into a dilemma. If you contribute to an IRA, say on December 15th, and then you call your financial advisor, and let's just say Brian here is your financial advisor, because we do that stuff. So Brian, hey Brian, I want to convert it, and it's December 28th when you decide you want to make this conversion. Banks may be closed. So if you notify him on the 28th, and he files all the paperwork properly, but the banks don't move the money until January 2nd, the conversion happened next year. It then didn't offset, and now you've just busted the whole darn thing, and it actually creates taxable income next year. So I just knock my own out every year in January. There is no dilemma. There's no bank delays. There's no headaches. I'm done. I know it's a great strategy for me and my family and for my wealth accumulation. So I just do it. And then if you're an old person like me, that you're over 50 and you can also get the bonus, great, take the bonus conversion as well. I might as well get every little dollar I can in tax-free distribution in retirement. So the backdoor Roth is not subject to your income limits like a traditional or regular Roth contribution. So if you're curious more about it, talk to your professional. Again, there's tax implications and wealth implications. It's why we do tax and wealth combined here. We want it because there's obviously more than one factor to deal with that. But if you're going to do it, I would recommend chat with your financial advisor and your accountant and have them in the room together to make sure it fits your specific situation. I will say it fits beautifully in most situations, but maybe your cash flow won't support it. If you've got more questions, let me know. Hopefully that is a valuable little tax trick for you. Thanks, guys.